Welcome, everyone. I am Stephanie Ricca. I'm editorial director of the hotels reporting team at CoStar News. You might remember us as Hotel News Now. It is great to be here at the start of the new era for the Hunter Conference, right? Pretty amazing space. So what we're going to do for you this afternoon is really set the stage for what we're all going to be talking about over the rest of this week at the conference. You know, the speakers up here see every angle of a hotel deal from their perspectives. And what we're going to do for the next 45 minutes is just walk through what's going on in the world today, how that has an impact on, whether it does, on hotel transactions. We'll talk about recent news, we'll talk about headlines, we'll talk about all of it. So welcome to my panelists. I'm going to have you all introduce yourselves, but you know, it's so great to be here with legends like Dan Peek, Mike DePrima, Greg Friedman, wait a minute.
Greg?
Not those guys. Are you hotel industry people?
Car washes. Is
Yeah.
this the car wash
Starbucks.
panel?
I work at Starbucks.
This
I'm moving to Florida too, but
is going to be an amazing conversation. So we had a wee pivot in speakers this morning due to the weather, like Lee and Teague explained. So we found some people who happen to be really good. They don't know what we're going to talk about, so this is going to be a fantastic conversation. Now, I promise we will not make any sort of weather jokes like correlated to industry health, you know, snowstorms at Alice, rainstorms at Hunter. No, we won't talk about it until there's a plague of locusts at the NYU conference. Good? Good.
Fair.
All right, let's get started. So we're going to go down the line, and we'll start with you, Bob. Introduce yourself. Give a little bit of color about what you're doing and some recent news with your company.
okay. Bob Webster. I'm vice chair and president of CBRE Hotels here in the United States. Started with CBRE on April Fool's Day, 2020.
Wow. Okay.
So it's been quite a ride.
Wait, what was happening then? What was so significant? April?
Well, we had negotiated prior to the pandemic, and I've been in hotel real estate since 1985. So I think that's 40 plus years. So I find these moments in time very interesting. There's a lot of commonality to downturns. We've been through probably 5 downturns in my career, deep downturns in my career. So there's a lot of similarity, and there's always those nuances of difference.
So nothing to worry about, right?
Nothing to worry about.
We can take it from the pro.
Yeah.
Carolina.
Carolina Bernal, nice to meet you all. JLL Hotels in New York. I was at Hodges Ward Elliott prior to that, HFF prior to that, Xenia Hotels and Resorts, where I started my career in hotels. They didn't just pick me off the streets this morning. Currently at JLL, I cover the global hotel desk, and I also cover the Middle East, so we'll have some interesting things to talk about.
Love to hear that.
Very interesting. Brian.
Good morning, everyone. Brian Waldman. I'm the Chief Investment Officer at Peachtree Hotel Group. Been with Peachtree for about 10.5 years now. Responsible for our investments, asset management, portfolio management. And yeah, they did find me at a coffee shop this morning, so.
He seemed qualified. He was wearing a suit. Sold. Evan.
Hi, good afternoon, everyone. Evan Weiss, LW Hospitality Advisors. We founded the firm about 15 years ago. We just celebrated 15 years, primarily focused in valuation, appraisal, feasibility market studies, litigation, sport expert testimony, third-party asset management, and our Lark data analytics platform. And I have to say, I give a huge shout out to Lee and Teague and the entire team here, and Sarah, because somehow they got our headshots and our names and our companies on this thing literally in 5 minutes. So, and all of us truly appreciate being third tier. So thanks, guys. We appreciate it.
No, this is absolutely the A-team.
Awesome.
Just listen to their credentials. You know what? All due respect to your colleagues who are going to be with us this morning, I think this group is better. So
I love it. Yeah.
let's get
Definitely
started.
more fun.
Talking about some headlines. So as we know, the hotel industry likes to pace its mood along the major conferences, right? So at Alice, I feel like people were generally, I'm not going to say cautiously optimistic, realistic, not expecting too much out of the hotel transactions environment in 2026. Would you agree? Thumbs up, yes, that was January?
Yes.
All right, so a few things have happened since then, right? So I want to start with talking about how you assess macroeconomic risk on a day like today, right? We've got a new war in Iran, we've got tariffs, maybe we have them, maybe we don't, we have a choppy stock market, but again, uncertainty is the name of the game. So, Brian, I want to start this one with you. How do you think about macroeconomic risk and what you should worry about in your job and what you can tune out?
Absolutely. I think to start, there's clearly a lot of noise out there, and I think we've been dealing with a lot of noise for the last couple of years. And with that, I think a lot of investors, lenders, market participants have done their best to bury their head in the sand kind of in the best way, meaning if you don't have to do something, don't do something. And that has just continued to kick the can and kick the can. And now we're at a point where I think a lot of those groups, doesn't matter which side of the table you're sitting on, you've kicked the can kind of as far as you can, and now things have to happen. Coming back to your comment about Alice this year, I'm a little bit cynical, but it was definitely cautiously optimistic. But I think some of that was also from the same people that have been sitting on their hands for the last 3 years, and they wanted to actually come to work and get something done and do deals. For us, as we think about risk, we do a lot of different things. We buy, we build, we lend, and within each of those platforms, we do a lot of different things from, on the lending side, bridge lending, PACE lending, EB5, SBA, film finance, they're all different businesses. On the equity side, we invest in different ways. On the development side, we invest in different ways. So when I look at my job and kind of where we spend the most time with the investment committee is how are we pricing risk? And at the end of the day, there are deals that could be done, but are you getting the right risk-adjusted return? And as the market moves, it's making sure that we're leaning into the right places where you're getting the right risk-adjusted returns. So if you look at what we've done in the last few years, we've been very, very active on the credit side because I feel much better being at 60, 70 cents on the dollar than trying to call what's 100 cents on the dollar, or if I'm developing, I'm going to say 110 cents on the dollar with all of this volatility. So, I think that's key for wherever you sit, wherever you're focused in your respective business, is just make sure you're not only looking at what the model tells you, because I can give you a model that tells you whatever you want. The only thing that I know about models is every model in my career has been wrong. We either
Jot that down, everyone.
100% of them have been wrong.
Yeah, you're either too conservative, too aggressive, but you never hit your underwriting exactly. And it's just making sure that you have the confidence that when you're wrong or when the markets move, that you're grounded and you're taking on the right risk and you're getting paid the right returns relative to the risk that you're taking on.
Carolina, how do you approach it?
It's very interesting because it really depends on how you're underwriting or who you are, right? Specifically to our industry in the way that we underwrite things, obviously what's going on with the war, we've seen it, right? If you drive, you've seen gas prices skyrocket in 2 weeks. We tend to see things on a positive note. Obviously, it's kind of hard to do that with this situation, but the way that we compare this situation to, for example, post-COVID, 2020, 2021, there's going to be less Americans going to Europe and the Middle East and that side of the world, and we're going to get a lot more traction here in the United States. So all those drive-to-leisure markets are going to hopefully boom again. So that's kind of how we're thinking about it, right? So yes, you have to focus on the risks, but also you have to also kind of think through the positives of it.
Those next 2 to 3 steps ahead.
Correct.
Once you get through.
And we have seen that before, right? Like the leisure markets, for example, in Florida, and the luxury resorts that really boomed after 2020, right? That never necessarily went back to 2019 levels. This is an opportunity for those for that product, and it goes back to the K-shaped economy, right?
Yep.
That we'll talk about, but it's an opportunity for those markets to ramp up again.
Okay, so Bob, in your experience, can you see the opportunity of a time like this, of a market like this, given the macro risks that seem to just keep replacing themselves year after year?
I think there's great opportunity. It's probably, in my career, top 2 best buying markets I've ever seen.
Oh, wow.
And I would have said that pre the war.
Okay.
So the war injects a whole nother level of underwriting risk. The only thing I'm looking at right now is and listening to what our debt team is telling us and whether it's impacting spreads.
Sure.
Because if you look at kind of, the math of owning is predominantly leveraged. Leverage has a big impact on the cost of capital, the all-in cost of capital. And what we've been seeing over the last year in the debt markets is, one, the base rates come down, and spreads have come in a big way. And so theoretically, that should help the sellers on value, because the math is the same but better for the seller, and they might be more inclined to sell. So I think if you look at fourth quarter of last year, first of all, last year transaction volume was up 15%. It's still, I don't know, 40% below norms, but it was up 15%. All of that happened in the fourth quarter.
Yes.
And so the fact that the cost of capital is lower, it helped prices, and sellers were able to transact. So it will depend going forward. Anytime there's a spike in risk to investment, typically rates will go down, not up. And if rates go down, it will help hotel values and will probably really help the transaction market. I think Q1, and Evan knows this much better than I do, but I think Q1 is actually going to be another big quarter of transactions. And I know you track the pipeline.
Yes, preview for
so,
Evan.
So I'd like to hear from Evan as to what you're seeing. You're much
Is the
more an expert than I am.
optimism well-founded?
I'm optimistic for there's 3 advisors and 1 owner-lender on the panel. I'm optimistic for us. I don't know about for you guys. I mean, the truth of the matter is that hotels are a long-term hold for a reason, right? There truly should be 7 to 10 or more year holds. And, the sort of the private equity entrance into hotels over the last 20 or so years, it's kind of makes the market much more difficult trying to sort of time the market 3 to 5 years. So where are we from a macroeconomic perspective? I'll be very candid with you guys. The 5 of us up here don't know a whole lot more than you do. We all see the transactions. Maybe we know a little bit more because we see a lot more sort of reps. But ultimately, it's a highly cyclical business. Right now, I agree with Bob. It's a phenomenal buying opportunity. And I think that there are going to be a fair bit of transactions. My personal opinion is that they're sort of going to be barbelled, sort of sub 40 and plus 140. I think the middle is going to be a little bit more challenging, the sub 40, because those are $10, $15 million equity checks that families, family offices, or a lot of the folks here today can sort of compile together. And then the larger stuff, because you have larger players out there that want to put out $50, $100+ million equity checks, on a 2/3, 1/3 debt to equity ratio. I mean, listen, the reality is also that if you really want to have a more certain environment and you really want to make, very sort of straight and stable cash flows, you should probably be investing in industrial and data centers and get out of the hotel space altogether. But, if you're in the hotel space, get ready for a rocky ride and understand that you don't know what's coming next.
Another great takeaway. When you mentioned that just now about that idea of now's the right time to do it, I had a quote jotted down from a similar panel at the lodging conference because I loved it. Whoever the speaker was said, "We as an industry tend to go very quickly from fear of making a mistake to fear of missing out," which it sounds like is describing that sentiment. Right. But Bob, I have to ask, if this is the second best environment for buying hotels, what was the first?
First was the early 90s.
Okay.
Yeah.
How do we look
There
now?
was so much money made in the early 90s. I mean, private equity was formed out of the early 90s. CMBS was formed out of the early 90s. That all happened because there was no capital. No capital starting in 91. The market, 1,600 banks went out of business. So you couldn't get debt and you couldn't get equity. So some very smart people found out, some old syndication models. For instance, REITs in the 1970s was a great way to aggregate capital, and they failed in the 80s. They got kicked out of capitalism for 10, 15 years. And then in the mid-90s, some very smart people decided, you know what? There's no capital. How do we take advantage of the fact there's no capital? And that's why I think 5 REITs were formed in 95, 96, maybe more, right?
I don't know, I was like 13, Bob. I don't
Okay,
know.
yeah, what am I asking for?
I mean, I know I look a little old. Jeez.
I can't ask.
I mean, we know Carolina wasn't around fine, but maybe Brian. I don't know.
5, 7, 5, I don't know. Probably at least a half dozen REITs were formed for that very reason. And then CMBS, and then on the debt side, CMBS was formed. And so, you know, capital is always the same through every cycle. It is individuals investing their hard-earned money, profits, into a fiduciary regime. So if you look at over the last, however long capitalism's been formed, but I've tracked it back to the 1970s. If you look at every investor who was investing in hotels for every decade since the 1970s, the source of capital is always the same. What's different is the fiduciaries. And fiduciaries sometimes are good fiduciaries and they stay. Most fiduciaries, there's a flaw in the model and that fiduciary fails. People lose the money. They get kicked out.
And then new models?
Yeah, but capitalism is a river of self-correcting errors. So it really gets better every decade. And you look at REITs today. REITs were highly leveraged in the 70s. That's why they all collapsed. REITs are very lowly leveraged today, and that's capitalism fixing that flaw. I don't know if that answered your question or not.
Well, it all leads to the question of who's buying today? Who's buying hotels? Where is that money coming from?
Is that to me or fewer than before?
Okay, so comparatively, based
right.
on when we saw that last amazing buy now period.
What's happening today happens in every cycle. Every cycle. You have a fiduciary rollover of sorts, where you've had this catastrophic moment in the hotel business, the pandemic, probably one of the worst crises in human history. And what is happening is a lot of equity has either been recognized as a loss or is what I would call zombie equity that hasn't been recognized as a loss yet, but everybody knows that it's a loss. So fiduciaries who place that capital, that fundraising is not as big as it used to be, and others who have fresh minds and fresh capital and a fresh viewpoint, they're the ones kind of stepping in. Like you look at all the buyers last year, they were all formed in the last 5 years, for the most part.
Yep.
Brian, what makes an attractive investment for you?
Yeah, I mean, I think, to Bob and Evan's point, I think wherever you are in the market, there are opportunities. The question is, can you find those opportunities? Can you capitalize those opportunities? Can you get comfortable with the risk associated with those opportunities? And if you can, at any point in the cycle, we're still a street corner business, there are good opportunities. You just might have to work a lot harder to find them. I think about where we are in the cycle today, and everyone in here that's an investor wants to buy low and sell high, right? I feel like we're at the start of a new cycle, and I think there are some really interesting opportunities out there. To Bob's point, I think that we are definitely an industry that has serious FOMO, and it takes something to happen, and then everyone wants to jump on the bandwagon. I use San Francisco as an example. Yeah. 6 months ago, San Francisco was redlined. It was awful. And then a small New York private equity firm that's a household name bought some properties there. And I mean, you guys can probably talk about it better than I can, but my understanding is now every private equity shop out there is trying to figure it out and understand those markets. And if that shop is smart enough to capitalize on that opportunity, I don't want to miss out. I think for us, as we look at it, like I come back to, are you getting the right risk-adjusted return? Do you have the right capitalization to make that deal make sense? And if you do, I think it's not easy, but you will find debt, you will find equity, and you'll go and you'll do good deals.
Do you see the FOMO, Carolina?
I do, yes. I think in what Bob was saying is very correct as far as transaction volume last year, right? We had the most, at JLL, we had the most traction at the end of the year. So the second half, we were 50% above, we ended up the year 18% above 2024. But what we saw was Blackstone made a move, bought the East Hotel in Miami. Brookfield made a move, bought the Sheraton Phoenix. Once those two names start buying, everyone's going to follow, right? And that's what we've been seeing. And it's just data, right? And yes, there's the cap rates are one thing. The talking about replacement costs is very important. But once those household names start investing in not in small pieces, right? They're pretty large check sizes. Then you see everyone else that has been on the private equity side sitting on their hands, for lack of a better kind of statement. They're saying, okay, if those guys are investing, now it's our time to do it. And we have seen a lot more private equity being able to be aggressive. And it also helps to, to have the debt capital costs come down, right? From September 2024 to now, we've had a compression of about 300 basis points. That makes a difference. We always talked about negative leverage. Now we're not there, we're not there yet, or not there at all. So now we're able to really push our pricing. Mm-hmm. So we're definitely seeing private equity step up. We've seen international capital come in, and that's something that's going to be very interesting to see how that evolves.
Yes, and I'm going to ask about that, so put a pin in that. But Evan, while we're on the topic of transactions, Brian and Carolina talked about like that, sort of that moment of sort of opening the gates, right? And I feel like this year, even so far in January, we've seen a couple good luxury hotel deals. What do you see from transactions this year alone?
Most of the capital markets folks that we spoke to last year in 25, told us that their business is somewhere 85-15, 90-10 in terms of refinancing, in favor of refinancing versus transactions. Yes. So far, it's not that far off. Maybe it's 80-20, 70-30, but it still way favors refinancing. On the valuation side, we do 1,500 to 1,600 hotel appraisals, market and feasibility studies a year. And that sort of component of 80-20, 70-30, that ratio is still holding fairly strong. So yeah, we're seeing some transactions. That being said, and kind of tying what my fellow panelists and you've been saying, debt is a huge boon right now. There are a ton of private credit lenders out there. I mean, Brian has more competition daily, right? Literally. Right. The banks are back in the hotel space, both big and small, regionals, locals. Everybody kind of wants to get in because office is still sort of persona non grata. And so there's a lot of debt. And the debt, to Carolina's point a moment ago, is much less expensive than it was. The spreads have come in dramatically. And so it's now you can get hotel debt pretty comfortably for stabilizing or stabilized assets, in the 200s over, in the low 200s to mid 200s. That hasn't existed. And so that is really kind of pushing a lot of folks back into the space because at the same time, what used to be a 6.5 or a 7 cap today could be an 8.5 or a 9. The sort of extend and pretend, the idea that, we'll buy it at a 7 and sell it at a 6 or something crazy like that doesn't exist anymore. The reality has set in. And so folks out there are saying, yeah, I'm not buying at anything lower than an 8, 8.5 post CapEx all in minimum because I'm taking out debt at 6, 6.5, even 7. And by the way, I need to exit at an 8.5 or a 9 in 7 to 10 years from now. None of this, we're exiting at a 6.5, kind of bull crap. So, I think the folks that are going to be the most successful over the next couple of years are sort of these multifaceted businesses like Petrie, not to sort of like blow smoke at them, but, hey, they can buy, they can manage, they can lend, they can do C-PACE, EB-5, all different kinds of lending products, USDA, SBA, right? I mean, it's a really interesting environment because it's sort of, hey, we can do that, and how can we fit you into the right bucket? And in terms of transactions, like I said a moment ago, the 40 and the 140, it's not a real range, but it's the idea that the can kicking is over. The folks that had debt maturities over the last 5 years can no longer extend anymore. Frankly, they want to recycle their capital. They're willing to say, hey, let's take back our 50 cents on the dollar. It's time to bake in the loss and move on. If they're funds, they're for sure willing to do that because those fund lives are pretty much over and they want to bake in whatever gain or losses in that fund so they can go out and raise new funds and make more money on fees and whatever it may be on the private equity side. And listen, CapEx is going to push people CapEx and PIPs are going to push people to transact. They're not going to have a choice. Special servicers are seeing more inflow of new deals than they have in the past 3 or 4 years since 21. And they're going to transact. They're not going to hold those things on their books. They don't want them. A lot of lenders don't want to own, so they'll either sell the paper or they'll sell the assets. So we're going to see sort of, it's going to be good in the sense of like a lot of luxury stuff. That stuff could still trade at like, 5.5 to 6.5 or whatever because they're marquee. But then the lower tier stuff is going to get pushed out to market at 8s, 9s, and 10s because it's time and the debt capital exists. And let's be candid, there is an absolute ton of equity money out there just sitting on the sidelines that needs to get deployed.
So, first thing I want to say is I appreciate the commercial.
It's really my
I have the $100 for you. I'll give it to you in the back room after. But I think to that point, like I think when you look at the market today and you look at industry fundamentals over the last, all right, take out COVID, not 2000, 2001, but overall as an industry, we've done okay. And there's a handful of markets that have gotten crushed for a number of reasons. But overall as an industry, performance hasn't been terrible. Where I think a lot of the pain comes is on the balance sheet side. You borrowed at 4% and that's now 7%. You borrowed at 70% leverage. You haven't done a renovation. You haven't done anything. You haven't had any RevPAR growth. And now the best that you can get is 60%. You don't have the cash to bridge the gap. By the way, during that time, you didn't do your PIP and you haven't been reinvesting in your properties. And that becomes very expensive. Yep. Are those assets fundamentally good assets? In a lot of cases, yes. But it's the balance sheet, it's the capital stack that's broken. So now to Evan's point, I think, people had been kicking the can, investors have been kicking the can, and now I think a lot of that is getting cleaned up. You can get more reasonable debt from a lot of different lenders. For the equity shops, I think there's, a decent amount of capital that's been sitting on the sidelines that was raised coming out of COVID because people thought it would be the next RTC, and that never happened, but the capital is still there. So I think you just sort of need that day of reckoning where owners that were feeling that pain kicked the can because they could. The brands gave them extensions, their lenders gave them extensions, their equity investors gave them extensions. And now people are saying, okay, we need to figure this out. We need to clean this up so we can get back to normal. And I think there are groups that are going to lose money. There are groups that are going to make money. But I think that this is a natural part of the cleansing.
Yeah.
And last point, and then I'll turn it back over to you. And like, if you look at everything that Evan just said in terms of the cap rates, the cost of capital, I want to exit at a 9, that's normal. Bob, if you look through your career, like hotels selling at 6 caps aren't normal. They've never been normal up until the last cycle. So I think we're just sort of reverting to a more normal cycle. And I think that's good because risk should be priced.
The only thing I would add to that and sort of maybe slightly disagree is that from an operational perspective, we are seeing challenges. RevPAR growth in the U.S. was sub 1% last year. RevPAR growth this year, according to LARC, Lodging Analytics Research and Consulting, write that down. Yes, it's a partner firm, obviously. Their prognostications this year are for 0.6% RevPAR growth for the United States. Yes, of course, markets, assets are different, but 0.6 is quite a low number. It's one of the first times in history we've seen a decoupling of GDP growth and RevPAR growth. And so 0.6, and by the way, that's with World Cup, which is expected to have a 1 to 2% bump in overall RevPAR. So think about that. Without the World Cup, we may be negative prognostication for this year. And in addition to that, we're also seeing margin erosion on the bottom line with cost of goods and labor, especially labor, as well as taxes and insurance increases. So we could see a basically roughly 0% RevPAR growth, along with 200 to 300 or even 400 basis point decline on margin, and that could result in declining NOIs, not negative NOIs. We'll still be fine, but declining NOIs in 26, and maybe even in 27, depending upon your market. Now, some of the sort of tailwinds would be that supply, given how expensive construction is definitely down, and that should create opportunities in certain markets, like in New York maybe, et cetera. But those metrics are not great, and when you couple them with all the things we were talking about earlier, it's going to be a challenging year. And to your point, Brian, I think things will start selling at more normal, sustainable, both cap rates, so investment rate returns, as well as prices per key.
You disagreed with me. I will say I agree with a lot of what you said, but the perspective that I put on that is when you look at commercial real estate, yeah, we're probably going to be close to flat, maybe slightly negative, but look at office, look at multi, look at just about every other asset class, and when you put it in perspective, hotels really aren't that bad. It's not great. I'd love it if we were getting.
Really aren't that bad. What better compliment
That I'll agree with.
can we have?
You don't suck that much.
So I want to know what does this sort of perfect storm scenario that you're brewing up mean for what actual hotel landscape in the U.S. is going to look like? And Bob, I want to ask you this one. So if we're saying that, all right, there's always going to be, or sort of a lesser gap on luxury, right? There's going to be that buyer who wants it for all the reasons. But then there's a whole lot of hotels at that mid to lower level that their current owners just want to sort of get rid of because they have to. What does that do to the overall hotel landscape over the next, say, 3 years? Because you've got the sort of, I don't want to say damaged, but a difficult capital stack that you're working with. What does this do for all sorts of other transactions and even operating fundamentals?
So are you saying from a value perspective? What
I think from a value perspective, right. So what's going to have to
the
happen
value of
to
hotels?
these hotels?
It depends. It depends. To your point, there's two. First of all, I think net asset values by the end of this decade are going to be surprisingly higher than what people are thinking today.
Okay.
And the reason is, and we talked about this last year, really, you have to keep this simple because we're a very complicated silo in real estate. And so if you keep it really simple, it's about really, values are based on two levels of supply and demand. The first level of supply and demand are rooms. So what is the supply of rooms at any given time? And what's the demand for those rooms? To Evan's point, the demand has flatlined on us, which is never good. But I look at demand like it's transitory. You have good quarters, you have bad quarters, you have good years, you have bad years. I'm much more focused on supply. And towards the end of this decade, the rate of growth of some math of history, the last 30 years, the rate of growth in supply has been 1.7% annually. Compounded annual growth rate. We're going to be half of that to the end of this decade. Supply is structural to the underpinning of value. So that alone, I think, is a table pounder, and that has not happened in my career.
Right.
So I'd say that's a very good thing. And I would probably take the under a half, actually. I'd take the under on that. The second level of supply and demand that generates value is the capital markets. How much liquidity is there in the capital markets? What's for sale at any given time? And what's the appetite and risk for that investment? Knowing that there is always a buyer for something at all times. So that's just the fact of the market. So you have to then pinpoint, well, where do most buyers want to be? And right now they want to be in resorts. So those multiples are going to be much higher than where they don't want to be, and that's maybe some ground leased hotel that's union that does $5,000 a key of NOI. Those hotels are will have a buyer, but not at the same multiple, say, as a resort.
Which is why there are different buyer profiles for all of these segments of hotels.
I mean, I think broadly, Evan hit it, I think, right on the nose. I think broadly the market kind of wants to be, on average, when you put everything into the same sort of value pot, I think the market kind of wants to be all in 8 to 8.5. I think we'd all agree to that. And when you think through that math, when was the last time we had cap rates that high? A long time ago. And it's pretty hard to screw that up, honestly. I don't know how you screw up buying at an 8.5, selling at maybe an 8. The math works on a leverage model to about a 1.25 to 1.5 CAGR of NOI growth through that. I mean, it's pretty hard to fail. It's hard to screw that up.
I mean, Bob, to your point, at those levels of returns, you kind of need that, right? I mean, you can invest in industrial, multi, retail even, et cetera, today at somewhere in that sort of 6.5, even 7. So there should be a 200 basis point difference between owning real estate and highly complex operating business intertwined with bricks and mortar real estate, right? So that premium hasn't existed for a few years because of market dynamics and desire and demand, but now it's sort of, to me, the market's normalizing. It's not even stabilizing, it's normalizing to where the premium, the risk premium is actually being reflected in the cap rates and the rates of return that most people are expecting. And when you try to BS your model, to Brian's point, you can put a 20 IRR in any model. Brian and I sitting there for about 3 minutes can make that happen. But I can promise you, what's that?
Goal seek.
Yeah, goal seek, exactly. I don't know how to do that, but
Goal
yeah,
seek.
that guy.
No, you have an analyst that can figure it out.
Exactly,
for you,
same.
Does that sound right to you, Carolina?
Absolutely, it does. And I think, it really depends on how you look at the market and where you are in the market. Obviously, investors that are underwriting luxury are going to be very different from investors that are underwriting, select service, extended stay, right? And when we go back to talking about the K-shaped economy, right? Luxury is up 8% year over year. Economy is down a little bit, right? I think it really just, you have to analyze it, right? Like you can't necessarily focus too much on the overall market fundamentals. You have to focus on your specific market, where you are in penetration, and what you can do in efficiencies for that hotel, right? So I just think everyone's gonna have a different experience and a different thought process behind it.
We are a street corner business, and I think there are so many pieces of that street corner business that are critical, because everything that we're talking about up here is big picture, but there are certain markets that have fantastic fundamentals. There are other markets that are still.
What are the good ones right now?
I mean, I think for us, we're primarily a select service, compact full service investor. We tend to invest in, the easiest way I would say it and take politics out of it is, where are the jobs growing? If the jobs are going to a market and you're seeing investment, it's probably a pretty good place for hotels. If you're in a market that's seeing pullback, someone made the comment about unions, where your expenses are going up much faster than your revenue is, you have property tax issues, things like that, those are the markets that we tend to stay away from. But I will also say what's interesting, we operate about 115 hotels today. So I look at, the numbers across the markets, and what we're seeing this year so far in Q1 is a lot of the markets that I had the most concern about in December are the markets that we're seeing the brightest spots in at the end of Q1. And I won't list all those markets on stage, but I think it's really interesting, because a lot of those were the markets that we were like, man, we need duration.
That was just this past December?
Just this past December to now.
Okay.
We've seen a big pickup in a number of markets. Now we have other markets that we haven't seen the pickup that we expected. But I think it's interesting, and it just goes back to the point of, we're still a street corner business. And to Evan's point, we're an operating business. We're
not really real estate.
We're not really real estate, but like the point that I would make is, as we've bought hotels, if we've invested in hotels, there are always operators that are going to be more efficient and less efficient than us. And there are certain operators that I love to come in behind, because I know, notwithstanding the pressures that you talked about, we could drop another 3-5 points to the bottom line. You take an owner-operator that's super efficient, and we bring in our operating model, and we may not be as efficient. So I really do think it's case by case, and understanding the investment that you're looking at making, and stick to your knitting. I mean, that's the other thing that I think has been really interesting over the last couple of years. You have a lot of groups that were really, really good on the equity side that decided they wanted to be lenders, or groups that were acquirers that wanted to be developers. And I think it's really hard to do that, because you're doing that not because you want to be the best lender out there, but you see it as a market trade, and the market moves so quickly that I think you're better to be pure to your core and what you do, and be the best at that, and you can make money in any cycle.
You know why hotels are so difficult?
We make it that way.
Yeah.
we make it that way. We're our own worst enemy.
Overcomplication.
The more complex
All
they are,
real
the more
estate.
difficult.
What's the commonality of all real estate silos? They all turn over leases. So if you run out kind of the back of the envelope math, think about this. Office owners negotiate about 165,000 leases a year on average. You run that math out. That's a lot of leases. And what's interesting about office is you have an expert on either side of the lessor-lessee relationship doing battle for those leases. If you run the math out on hotels, we have 850 million leases a year that are negotiated. And they're not negotiated with a representative on either side. And I think we're missing the boat on the future potential of AI by, and who knows what happens with AI, but I don't think we can sit here and look to the end of this decade and not say that AI is going to be one of the biggest advocates for the negotiation of that lease on a nightly basis. Because if you think who negotiates those leases today, they don't have the perspective of AI. And I think we're going to have, again, I'm calling for a big run up in net asset value. And obviously NOI is a big component of that. I think rate compression could be significant with the use of AI. And then I don't think on the expense side that I don't think any of us would say that with robotics, particularly robotics with vision, I don't think we can sit here and say that AI is going to cost us more on the expense side by the end of this decade. I think it's going to make us more efficient, which again is an improvement in NOI, if it's true.
Well, let me jump in because we have 4 minutes left, and you perfectly transitioned to what my final question is going to be for each of you. Share one way that you are using AI in your daily life. Doesn't even have to be your job yet, your daily life. We've heard your thoughts on where you think that's going to factor into everything from pricing, revenue management to valuation. How are you using it today in your daily life? You'll each answer this.
I can go first.
Yeah.
ChatGPT is my therapist on a daily basis. I'm just kidding. No, we spend a lot of money on technology at JLL, and one of the biggest advantages that we have is the fact that anytime a broker has a conversation with a potential investor, we tag our notes and say, Peachtree is interested in this asset, this market. And then we have a platform that anytime we put an asset in the market or we're about to sell an asset, we run a target list. And that target list is pulling from all of these conversations that people are having, right?
Okay.
And there's hundreds of conversations that happen every day that we don't necessarily have the time to, go around and talk about it. So being able to just scrape data from those conversations and have a machine that is smart enough to figure out, what markets people want to be in. And sometimes it's conversations that don't necessarily happen on a day-to-day basis. It's a new entrant to the market that does retail and now it's interested in doing hotels. And it'll pull your name. Correct.
So keywords, looking at sort of database
which
management.
Is very interesting because we know who invests in hotel, right? Like we talk to them on a daily basis, but it's finding those specific buyers that showed interest but are not necessarily in front of everyone. I think that's going to be a game changer.
So there was still that human element of a conversation that you're turning into mineable data.
Which will never change.
Yeah, exactly. One way that you use it.
Yeah, so a few comments and then I'll tell you the way. So number one, of course, adapt or die, right? AI is coming, whether it's going to replace everyone from our driver to whatever it may be, or analysts, sorry, it's happening. So we just have to see where it's going to go. We don't know exactly where and how yet. I always quote Gary Vaynerchuk, the media personality, who says that AI is not going to take your job. Someone who knows how to use AI is going to take your job. And I actually very much agree with that, thank God, because I don't know.
Who's 15 years younger than you are.
Yeah. Exactly. And then the third aspect is that AI is kind of a little bit scary to me. And what I mean by that is I have 3 children, thank God, and I don't know exactly which direction to push them. Say, oh, you should go do this job. Coding out, right? Lawyers, how many will exist for every partner? Instead of maybe 10 associates, now they only need 2. And all these different changes that are going to happen in all throughout the industries, especially hospitality, from the on-site worker to the analyst in the capital markets and investment side as well. So for me, I'm a little bit concerned that either A, it replaces people, but do then prices go down with it, as Bob said? Does it cause compression in the pricing market, and therefore hotels are worth potentially less, even though they are getting more efficient on the expense end? I don't know. For us, we're definitely starting to invest heavily and search heavily. We've been using Claude quite a bit. Claude is proving to be the most accurate and thoughtful, if you will, of the AIs at this level for folks like us, without going enterprise level open AI and Anthropic and all that stuff. But Claude is definitely proving to be incredibly efficient at synthesizing data and potentially taking the time. In other words, if you put something in ChatGPT, you may get an answer in 30 seconds. If you put something into Claude in maybe 10 minutes, but the product that it produces is way more valuable, valid, and lasting. So it's a scary time. I don't know exactly where that's going, but we know that we have to know more about it.
You got to push your kids to pro sports or plumbing.
Yeah, so we're Jewish. That's not happening, but on either side, quite frankly.
Let's go real quick to close it up, Brian. One quick way you're using it today.
Yeah, we use it for, I'll call it the back of house platform. At the end of the day, we're in the hospitality business, and I think customer service is paramount to everything that we do, and being able to serve those customers and have a friendly face. I'm not a big believer in I come in, I check in on my tablet or my phone. I think there's a portion of customers that want that, but I think the way that you differentiate yourself is through service. So coming back to your point, if AI is telling me that this customer wants this or that customer wants that and I can deliver a better experience, great. Also coming back to the ownership side of it, we've invested a lot of time and money in AI and technology to help us with our platform. We have better information today. We understand the information that we have much better than we ever have before in terms of asset management, portfolio management, making better investment decisions. And for us, that is hugely valuable. Maybe someday we'll figure out how to have a machine that can change a bed. But in the meantime, I want my frontline people there providing service, providing hospitality, and I want to use technology to put us in the best position to make better decisions.
That's a great note to end on. I think it gives us all a pretty optimistic outlook for the next couple of days. Please join me in thanking our panel.
Thank you.
And
It's fun.
Always.
Always good to see you.
You too.